Hi, everybody. Welcome to our Wednesday home buyer workshop. My name is Patricia with eXp Realty, and this is Gustavo Segura with Sendero Home Loans. And we are coming to you today to bring you some excellent information on FHA loans and conventional loans. How are you doing today, Gustavo?
Doing great. Thank you, Patricia, for having me again. Thank
Yeah,
you.
of course. So I had a couple of questions that came up this week, and we do this call every week to provide buyers with information on the home buying process and what it takes to get into a home today. And one of the questions that came up this week was about FHA and about the premium that's required for getting the FHA loan. So we're going to talk today about the FHA financing premium and how that works and what the difference is with the monthly cost that's involved with an FHA loan. So Gustavo, I know we were talking about that a little bit earlier. And if a buyer is getting, let's say, a $600,000, they're buying a home that costs $600,000, what kind of scenario does that look like? They're going to be paying the FHA financing fee, and then there's also a monthly cost that's involved, right? So
Yeah.
can you tell us a little bit about how that works?
Yeah. So the FHA is a government loan program, and it's a great program for first-time home buyers a lot of times because of the flexibility that it has. The flexibility being lower credit scores, higher debt to income ratios, being able to have a lower interest rate. But that flexibility also comes with, an additional cost. And
Okay.
that additional cost is the mortgage insurance premium. So that mortgage insurance premium is what helps the lender in case of default happens. So the lender sees, okay, the government is backing this up. I'm able to be a little bit more aggressive and provide lower rates so that we can, promote home ownership, which is what the government wants, with
Right.
some flexibility, make these programs available to more people. But at the same time, the lenders, taking a look at the risk and saying, what, is there going to be a risk on this? Is there not? And the government is saying, well, we're going to go ahead and have this insurance that's going to help, and we're going to be able to take care of that if there's an issue. Now, that mortgage insurance premium that I talk about, there's an upfront cost, which is 1.75% of the loan amount.
Okay.
So that's going to be, if it's around a $600,000 loan amount, that's about $10,000 that's going to be added to the closing costs. Now, that can be financed into the loan if needed. So if the borrower doesn't have that money to on top of the other closing costs, they can go ahead and add it into the loan amount so they can be financed. Now that is what we call the upfront mortgage insurance cost. You also have a monthly mortgage insurance, which is just going to be part of your normal payment. So as we know, your payment is going to be your principal, your interest, your taxes, your home insurance, and then you have that mortgage insurance monthly cost that's going to be added on there. That goes towards the security of that loan. So that's something that, as you get an FHA loan, you want to make sure that you know these costs and understand why you're paying for it. And like I said, I like to explain to buyers is that yes, you have to pay it, and it may be a big number compared to your monthly if it's $200 or $300 extra, but you're getting the flexibility of being able to get a home now. If you have a lower credit score, or if you have a lower down payment, or you need to have that flexibility, it's a great option.
Yeah, and I think that's the key word is having that flexibility, because in today's market, prices are a little higher. They're kind of holding steady. I've seen a few price adjustments here and there, but going over, between now and the next couple of years, it is estimated that prices are going to hold steady and actually start increasing slowly, not as at an accelerated pace like we saw the last couple of years.
Right.
But we live in California, and especially in Los Angeles County and Orange County, these are cities that are highly desirable to live in. And so buyers are kind of, having a little bit of a struggle there with the interest rates. So I saw today interest rates are at 6.95 for a 30-year fixed. So the flexibility here with first-time buyers is that if you're looking at a 6.95 interest rate, of course, that's going to make your payment higher, but it's looking at the big picture and how to get into the home that you need to get into. So with
Right.
rents increasing, I think FHAs are, we talked about this last week, that they're making a big comeback right now. But I thought it was a good topic to just discuss today as far as explaining the premium that gets charged at closing. So that's part of your closing cost, or you can finance it, as Gustavo mentioned. And in addition to that, you're going to have the monthly FHA fee that gets attached to your principal and interest payment. So, for example, I bought my home about 7-8 years ago, and I bought it for $400,000. My premium monthly was about $250. So it wasn't too expensive. It was something that was affordable. I was able to put down $14,000 and get into the home. And as a single parent, that really helped me out a lot. And then I just had to save up some extra money for my closing costs. So I was able to get into this home and avoid all these, rent increases. So the other thing that I think is important is also really explaining about FHA when you're applying for a loan, if you're a single person or if you're a married couple, because sometimes only one person is going on the loan, or one spouse, and they're purchasing the property, and then they might want to just add their spouse to the title part of it. I had that question come up this week too.
Yeah.
But that's there are some rules that go there too, right? So
Yeah. Yeah, and that's a good question too, because again, it's a government loan, so the government wants to make sure that no one's going to default on it, and in order to do that, they're going to have some extra checks and balances there. So if you're married and you got one spouse that is going to go ahead and can handle the mortgage and the payment, and you're like, hey, we're going to put it under their name, they're going to go ahead and apply, and everything looks good on that in that scenario. But part of the FHA is that we need to look at the spouse in order to see what other debts may there be for the household. So again, it's taking a look at the whole household to see the full liability, so that there is no issue later on in that there may be some difficulty times making the payment. So for example, I've done these where we have the non-borrowing spouse, they have a car payment. Maybe they had that car payment before they got married, it was just under their name. And we have to account for that. So that could be an extra $400, $500, $600 payment that we need to account into the debt calculation, and that could throw it off, right? So sometimes you want to go FHA, but some of these guidelines don't allow, because there's additional liability on the spouse's side. So that's where we take a look at the assessment of the scenario and say, okay, you know what, because of this, we need to go conventional. With conventional, we don't have to look at the other person's liability. So depending on the scenario, we'll take a look at it, but we definitely have to take a look at the credit. We don't have to use the credit score, but we have to use the liability that's on there. And again, it's because they're married. They want to make sure that they look at a household level of total income, and then they can go ahead and take care of that.
Right. So those are all good points. And with an FHA loan, if you're thinking of adding your spouse to the title but not to the loan, you're basically still having to include their debts, right? But you can't include their income because they're not going on the loan, correct?
Yeah, not on the loan. They can be added to title, but on the loan itself, we need to look at their liability, and then if they're definitely going on there, then we'll look at both income and liabilities on there. Yeah.
Okay,
and also too, to circle back to with the first question about the mortgage insurance premium, that mortgage insurance premium will be on there, depending on your down payment. If it's less than 10%, it's going to be for the duration of the loan, so for the life of it. So it's a 30-year loan, it's going to be there forever. So that monthly payment will keep adding on, right, to your overall length. But no one's going to stay there for the full 30 years on their first loan, even their second.
Yeah. I've already refinanced, I think 3 times in the last 7 years. So it's highly likely that somebody purchasing a home would refinance as soon as the rates,
Exactly. So the way to get rid of that is you refinance into a conventional, and maybe, you know, it was a year or 2 years, you refinance into a conventional and you have 20% equity. So the whole mortgage insurance is also on the conventional side as well. It's just less. So if you put down your 3.5 for an FHA, you got the mortgage insurance monthly, you got the upfront cost, and then in a year later, property values went up 10%, let's say, so maybe you've got a 13-14% equity, you're still going to have a mortgage insurance premium on the FHA if you refinance into another FHA loan. If you refinance into a conventional loan, because you're still at 13-14% equity, you are going to have still a small mortgage insurance payment, even on the conventional side. So once you get to that 20%, then it's going to drop off on the conventional side. It doesn't do that on the FHA. So
Okay.
definitely is something that we can get rid of as the years go on. Depending on your situation, you know, we can see whether it's ready to be taken off now, or it's still going to be another year or two. So, you know, last year and the last couple of years when we talked about that, you know, 20% equity improvement and all that, it was very easy to get rid of mortgage insurance within a year and a half because the property values went up so quickly.
Right.
So
Right.
that's another way that, you know, they'll be able to get rid of that payment.
Yeah, and I think it's important for people to know that when you do have an FHA loan, you can have your loan checked. You can have it looked at to see,
Mhm.
you talk to the lender and see, let's say you've helped them get into a home, you've worked with them throughout the financing process, and now the escrow has closed. So after a year and a half, maybe 2 years, they can call you back and say, Gustavo, can you take a look at my loan and
Yeah.
let me know if you think I can refinance now and get out of this FHA premium scenario? And you can basically take a look at their equity in the property and also what their ratios are and seeing if they are able to qualify for a refi and a rate reduction at that time, right?
Yeah, definitely. And that's a great you know, touch point that we do. We follow up because we have some systems in place that we can take a look at the value. And then more than just going to, you know, a real estate website. It's more than that. We actually have a couple tools that we use to get a better assessment of the value. And if we're pretty close, and we can say, hey, you know, we're pretty close. I think it might be worth it to go ahead and invest on doing an appraisal so that we can go ahead and get rid of that, get you into a different loan. Plus, where's their credit at, right? So if their credit score has gone up, that's another point that we'll be able to touch on that will help them save even more.
Right.
Yeah.
Yeah. So these are all really important details that aren't really, well known, I think, in the home buying process. So we wanted to bring this information to you today. And, we do this weekly call every Wednesday to help people plan a roadmap to their home buying process. And we'd love to be a part of that process for you. And I wanted to also talk a little bit about rate locks because there has been some questions lately about, when should I lock my rate? Should I do it when I'm starting to look at homes? Should I do it when I'm in escrow? When should somebody actually lock their rate? What do you
Yeah.
advise your clients to do?
Yeah, so and a lot of the lenders will have a different approach on this. Of course, locking a rate means we're going to have to go ahead from the lender side. They're committing to giving you that rate. So if the rate goes up, they're committed to giving you the lower rate, right? So it's a security blanket for you. On the lender side, you know, they don't like that, right? They want to wait as long as possible so that when they lock it, it's when you're already got an offer in, you know, you got the offer accepted, and it's going to be 20 days here before you close on the actual property. That means that the lender has less risk, 20 days for any of the market changes to happen or for the rate to go higher and higher. But what I do is with my customers, I let them know, hey, you can start shopping now. You're pre-approved. I can do a 90-day rate lock that allows you to shop around, gives you a little bit of that security blanket. They may be able to find a house within 30 to 60 days, and we just guaranteed them that rate. So that's a great benefit. There's no charge on that. So that's something else too. When you're looking at rate locks, find out if they're going to charge you on it. Because like I said, there's no charge on it, but everybody's different. And then of course, when you're in escrow and, say you got a 90-day lock and you were able to get a house on the 70th day and you make your offer and you're going into escrow and you got 19, 20 days to close and it's about to expire, you can't let it expire. Of course, your lender should be letting you know and should be working hard to close that on time. But maybe you need an extra day or 2 or 3. Work with your lender. They should be able to extend that, no problem. They should be able to work with you on, is it a free day or 2, or if there's a small cost, it may be, $100 a day or something like that where it gets extended. But what you definitely don't want is for that rate to expire during escrow, especially in this kind of market, because if you locked it 90 days ago, it's going to be, half a point higher now.
Right, especially that's so true.
Yeah.
And in this market, buyers have the upper hand in getting negotiations, getting some seller concessions, and properties are sitting on the market a little bit longer. So sellers are really motivated to work with buyers, look at all offers, all terms, and basically get a buyer under contract. So in this market, it doesn't really matter if you're getting an FHA loan or a VA loan. Sellers are going to consider all offers and really work with the agents and the buyers to get them into escrow. I showed a property to a buyer that wasn't in the market for a purchase. They were actually renting, and I showed them a condo on Friday. They loved it. And I wrote up the offer and opened escrow on Monday. And so that's, at that time, I mean, it was a great time to go out and see the property. Had been on the market for 30 days. And, this isn't the market that we were in earlier this year or even 2 years ago, even last year.
Yeah.
It's, buyers have that flexibility where they can go home, think about the property, talk to their lender, talk to their agent, and put that offer together and not feel that pressure that they need to, go home and write an offer that's 50,000 over asking.
Yeah. Right. And on a house that maybe they're 75% sure that they want, that it fits their needs, so it's definitely a new market. And like you said, the buyer definitely has a voice now, and they should be able to voice that in a negotiation. So
yeah, absolutely. Okay, Gustavo. Well, thank you so much for joining me today on our home buyer workshop. And as I mentioned, we do this every Wednesday. We didn't go live today because we had some technical issues, and also Bill wasn't able to join us today. But I wanted to just provide this video and information for any buyers that are out there looking at homes and interested in learning more about the home buying process. We provide this content every week. And if you have any questions regarding financing, what's a good number for them to reach you at, Gustavo?
Yeah, my direct number is 714-334-4563, and text or call always works.
Okay, great. And once you have all the documentation, how long does it take normally to get a pre-approval?
Yeah, I can do a pre-approval same day. So it takes me, a couple hours to get that done, to go ahead and do it correctly. We'll need check stubs, W-2s. In some cases, I'll need the income tax. The income taxes, yeah. And like, again, it all depends if you're self-employed or if you're just a straight W-2 employee. So we'll go through that process. And once I have those documents, that allows me to go ahead and take a look at your credit and be able to work out these ratios about debt to income and then qualify you appropriately.
Okay, great.
Yeah.
And I'm Patricia, and I can be reached at 323-365-9909. So if you have any questions, feel free to reach out to myself or Gustavo. We're always here to help you, and we'll be honored to be part of your home buying process.
Thank you, Patricia, for having me. Thank you.
Thank you.